Hello friends, in this video we will understand about trading in equity. Let's get started. Equity trading refers to the buying and selling of company shares or stocks in the financial markets. It is a process of trading ownership in a company, representing a claim on the company's assets and earnings. Equity trading typically takes place on stock exchanges, where buyers and sellers interact to trade shares. Investors, including individuals, institutional investors, and traders, participate in equity trading to either invest in companies for the long term or take advantage of short-term price movements to make profits. Equity trading can occur in two primary forms: primary market and secondary market. One. Primary market. In the primary market, companies issue new shares through initial public offerings, IPOs, to raise capital. Investors can directly purchase shares from the company at the offering price. This allows companies to raise funds for various purposes such as expansion, research and development, or debt repayment. 2. Secondary market. The secondary market is where most equity trading takes place. In this market, investors buy and sell previously issued shares among themselves. The secondary market provides liquidity to investors, allowing them to easily convert their investments into cash. Equity trading can be conducted through different methods, including traditional floor-based exchanges and electronic trading platforms. It involves brokers or online trading platforms acting as intermediaries between buyers and sellers. Investors place orders to buy or sell shares, specifying the desired quantity and price. These orders are executed based on the matching of buy and sell orders. The price at which shares are traded in equity markets is determined by supply and demand dynamics. Factors such as company performance, industry trends, economic conditions, and investor sentiment influence the buying and selling decisions, thereby impacting stock prices. Equity trading carries risks including market volatility, company-specific risks, and regulatory changes. It requires understanding market dynamics, conducting research, and managing risks effectively. Many investors and traders employ various strategies and analysis techniques to make informed trading decisions.